Bitcoin just dropped 20% in 24 hours. Ethereum followed. And then every single altcoin in your portfolio turned red at the exact same time. And then you hear people scream on the internet, Bitcoin was supposed to be digital gold, a hedge against the old school legacy financial system. So why does it tank every single time the stock market bleeds? Well, in March 2020, when the S&P 500 crashed 34%, Bitcoin didn't act like a safe haven. It dropped 50%. So what's going on? And more importantly, how do you protect yourself when the entire crypto market moves as one? The truth is, crypto and stocks are more connected than most people realize, but acknowledging the fact means that we can adjust and prepare ourselves for it. In this video, I'm breaking down the correlation patterns that causes crypto crashes, the warning signs to watch for, and the exact steps to take before the next one hits. Let's investigate, starting with the one thing that drives both of them. Here is what actually controls both markets. Correlation. Correlation by liquidity and risk appetite. And in crypto, this is most obvious. Think about it like this. When Bitcoin sneezes, altcoins catch pneumonia, and low-cap startup altcoin token get a step to the chest. Liquidity, meaning money, flees into supposedly safer assets. However, you are not safe with the big boys either. For example, March 2020, Bitcoin drops 50%, Ethereum down 60%, Cardano, Solana, Polkadot, all getting destroyed at the exact same time. They are not just falling together, they are moving in perfect lockstep. And exactly here is the part that wrecks most crypto investors. If you own 10 different cryptocurrencies thinking you are diversified, you are not. During market crashes, correlation between crypto assets spiked to 0.8 to 0.9, which means 80 to 90% of their movement is identical. Your diversified portfolio, it's actually just one massive bet in one direction using one almost unified asset class. All tens of thousands tank together. You don't have diversification. You have concentrated risk disguised as diversification. And here is where it connects to traditional markets. This correlation doesn't just exist within crypto. It exists between crypto and stocks, and when the S&P 500 crashes, Bitcoin follows. And when Bitcoin crashes, well, it's like you bought 10 favorite flavors of ice creams, but they're all melting at the exact same time. So why does crypto follow stocks down like they are handcuffed together? There are 4 main reasons, and once you understand them, market crashes will make a lot more sense. Reason 1. The risk of panic. When something scary happens in the world, like a pandemic, a war, a banking crisis, investors get terrified. And when people get scared, they don't want Bitcoin or stocks or anything risky. They want cold hard cash. Cold hard boring cash sitting on the bank account. Or even better, cash having under the pillow. It's like when you are a kid and a thunderstorm hits. You don't want to be outside playing, you want to be safe inside. And that's what investors do. They run for safety. And here's the problem. In the eyes of most investors, crypto is far from being a safe house. It's the most dangerous playground out there. So when fear hits, crypto gets abandoned first. Number 2, the same people own both. Here's something most people don't realize. The same big players, hedge funds, investment firms, billionaires, they own both stocks and crypto. Back in 2017, crypto was mostly with regular people like us. But today, BlackRock, Fidelity, massive hedge funds, they are all in crypto. So when the algorithm or risk manager says, sell everything risky, they don't just dump their Apple and Tesla stocks. They dump their Bitcoin and Ethereum too. Same button, same day, same reason, same fuckery of retail investors. The margin call domino effect. Reason 3. Okay, this one's a little critical, dealing with the most disgusting thing ever invented in finance. Leverage. A lot of big investors don't just buy crypto with their own money. They borrow money to buy more money. And that's called leverage or margin. Now imagine stocks start crashing. Suddenly the lender says, hey, Your account is losing value. Pay us back now, or we'll automatically sell your stuff. And that's a margin call. And here's the nightmare. They have to sell anything. Stocks, crypto, gold, whatever they can just to cover the losses. It's not that they want to sell their Bitcoin, they are forced to. And when thousands of investors get margin called at once, everything crashes together like dominoes. Today, this isn't even a margin call anymore, but code that gets executed. In times where traders move 20 kilometers closer to the broker just to save a few more milliseconds for a faster execution of a trade. Yeah, you know what's up. Reason number 4, selling what you can, not what you want. The last one is simple but brutal. During a crisis, people need cash fast. Maybe they lost their job. Maybe their business is failing. Maybe they just got margin called. Maybe some invested money they couldn't afford to lose and are now seeing their world in shambles. So what do they sell? Whatever is the easiest to sell. And crypto? Well, it trades 24/7. You can sell it in seconds. Stocks? Bonds? Markets are closed at night and on weekends. So even if someone wants to keep their Bitcoin, they might sell it anyway because it's way faster to get cash. And here a real world proof. Look at March 2020. COVID hits. Stock markets crashes 34%, Bitcoin drops 50% in the same week. 2022. The Fed starts raising interest rates. The Nasdaq falls and crypto follows it down for 8 straight months. Ethereum lost 70% while tech stocks bled. The pattern is crystal clear. When traditional markets panic, crypto doesn't escape. It gets hit even harder. But here's where it gets interesting. And I'm not talking about buying like going short products like put options or other kinds of betting on prices going down even further. We get entry points. Okay, so next point, the warning signs. There are moments when crypto breaks free from stocks. Times when Bitcoin actually behaves differently, when it starts moving on its own rhythm. But those moments are rare and they never last forever. Until now, at least. Because whatever we like it or not, crypto still lives inside the same macro universe. Interest rates, liquidity, risk appetite. So the real question isn't if any other crash will happen, it's when the conditions for one are building up. So here are 5 red flags before a crash, in all shortness. First, Fed policy shifts, pretty much inverted to the current situation. When the Fed turns hawkish or hints at rate hikes, liquidity drains fast. Risk assets, crypto included, start gasping for air. Second, macro uncertainty. Geopolitical shocks, recessions, whispers, or banking stress. Fear spreads across all markets and Bitcoin's safe haven story fades fast. Third, extreme leverage. When funding rates push over a certain extent and an open interest hits record highs, the system is overextended. All it takes is one spark for a liquidation cascade. Fourth, correlation spike. When Bitcoin suddenly starts mirroring the S&P 500, jumping from a 0.3 to 0.7 correlation in days, it's a sign big money is trading everything as one risk basket. Yes, that could also mean adoption, but it also guarantees the correlation gets even worse. 5. Liquidity drain. Volume falls while prices still climb. That's not demand, it's distribution. Smart money selling into strength while retail celebrates. Okay, here's the takeaway. You can't predict the exact moment of a crash. Nobody can. But you can see when the conditions are ripe. If 3 or more of these red flags start flashing, tighten your risk management. Don't try to be a hero. And remember, right now, major stock indexes are sitting at all-time highs. So are a lot of individual stocks. Even gold is at a record. Nothing goes up forever. Not stocks, not gold, and not cryptos, so bonds and cash remain. And just as we saw in the last cycle around 2020, the higher the euphoria, the thinner the air gets. What's the solution and how to protect your portfolio when crash comes? You can't stop a crash. You cannot foresee it, but you can prevent it destroying your portfolio. You need to protect yourself. But protection isn't about avoiding crashes. It's about surviving them with enough capital left to play the next round. So here is what I do. No financial advice, certainly. So first is position sizing during high correlation. When Bitcoin starts moving in lockstep with stocks, correlation above 0.7, it's time to dial things back. Cut your exposure to about 50 to 70% of your normal size. Keep the rest in stablecoins or cash, because dry powder is your ultimate hedge when markets sync up. Second, diversification reality check. Owning 20 altcoins isn't diversification. It's just 20 ways to lose money in the same market, in the same situation. True diversification means having exposure beyond crypto, like in stocks, in bonds, in ETFs, in cash, in real estate, in whatever you think is ripe for you. That's how real portfolio survives cycles. Number 3, stop loss and take profit strategy. A sound one, preferably. So always have a plan before the chart goes vertical in whatever direction. Set stops around, let's say, 15 to 20% on swing trades. And when correlation spikes, tighten them even more. Discipline beats denial every single time. Fourth, cash reserves for opportunity. If you are 100% invested when the warning flashes, you have no room to maneuver. Hold some cash, not out of fear, but out of patience. Because when markets panic, that's when the opportunities show up. DCA versus timing the bottom. Trying to catch the exact bottom is just gambling with extra steps. Nobody can do it, it doesn't work, has never, will never. But dollar cost averaging during 30 to 50% drawdowns put you in a very good position. That's what smart money does quietly while everyone else panics. The whole situation needs something of a mindset shift. The traders who make money are the ones who are prepared for the crashes. He who stay calm, stay liquid, and buy when everyone else is forced to sell shall have the advantage. Because in every circle, history repeats itself. Fear creates the bottom and the destruction of trading accounts, while patience builds the next fortune. So there you have it. Crypto crashes happened because of correlation with traditional markets, institutional behavior, and forced liquidation. The patterns repeat every circle. But now you know the warning signs and how to protect yourself. Subscribe for crypto and trading knowledge. No hype, no bullshit, just actionable insights. Let me know your thoughts in the comments. Next video deals with why most crypto projects fail and how to spot the winners. You'll want the free PDF checklist that comes with this one. And no, I do not collect email addresses here, and that will be a simple download. No questions asked. Okay, that's it for this one. So remember, in crypto, understanding the pattern is your best protection. See you in the next one.